Welcome to another edition of Anatomy of a Trade. This is going to be an interesting and special edition because once again, Johnny Scan is taking a break, and I'm joined by my mentor and everybody's favorite Wyckoff teacher, Roman. And he has this trade in Tesla, which is a great trade we're going to look at. It's to the downside. It's a short. It's actually using puts. And I know Roman is going to be difficult on himself because he always is. But I think when we go through this trade, we're going to see it's really a wonderfully executed great trade. So with no further ado, welcome Roman, and let's take a look at your Tesla trade.
Okay, sounds great. Well, Franz, thank you so much. I'm so happy to be back. Kind of like this cameo appearances on the show. Just want to comment that what a great job Franz and John are doing together with the anatomy of the trade. I read some of the comments below under these certain videos, and it's definitely that you guys have followers and people are waiting for this video, so I'm really happy to contribute. With that, here's the trade, Franz.
Okay, well, let's analyze this. And I love that you've shown us a really big time frame here, not necessarily a higher time frame or daily, but just a big going back historically, so we can really get a good sense of what is going on with Tesla here. And from the left to the right, we see a really strong rally from June of 2021 into November of last year. And notice this area that Roman has just highlighted. Look at the volume signature. Look at the individual signatures of each bar going up, and clearly, and just the aggressiveness of this final move. Look at the spreads that he's outlining for us there. If there was ever a textbook definition of a buying climax, here it is. So we've got this, and then we've got our work set out for us, because when we reach a buying climax, what do we expect next? Well, we expect a change of behavior, and there we see it. And notice how aggressive the single change of behavior bar is. One of the things that we're taught, that Roman always beats into our head, is that as we enter a trading range, we're looking for a either confirmation or disconfirmation of bias. And for the bias here, which is up, bullish, to be confirmed, we have to go through our analysis and determine whether it is indeed a bullish continuation or whether there's a change in character. And just this very first huge selling bar to the downside might give us some pretty good inclination that, hey, there's something different going on here. Look all the way back to the beginning of this rally. Where do you see a bar anywhere near this aggressive on the to the downside? To the upside, yes, but certainly not in terms of a failure. So that initially is going to give us pause to think, but it does create for our participants in Tesla at this point a at least temporary undervaluation. And immediately into that, we get our test, which we call our secondary test. And notice again, so we've got phase A, and notice again where this secondary test comes to now in this structure. Is it able to overcome the previous high? Well, it does slightly, although it doesn't commit. Notice that it doesn't commit against that big down bar in the automatic reaction, and it immediately, it's got a hidden up thrust here. We can't make further progress, and down we go again to a sign of weakness. So Initially, we've got this big change of behavior bar. Now we've got a sign of weakness. Already, I think we might be scratching our heads and saying, well, is this truly going to be a bias continuation to the upside? Or is this trading range establishing something different? And we get a rally off this sign of weakness as a minor sign of weakness. We come up again, no ability to commit above the previous area, and it's not even an upthrust. It's an upthrust action that, as Roman's indicating here, fails. We see demand, as Roman's pointing out here. Demand is slightly increased, but notice versus the buying climax, and notice what the result. So what's the effort versus result here? Not looking too good at this point. After this failure, a quick revisit to the support, and then an attempted test back up, can't get past the middle of the range, and then down we go to a major sign of weakness. And this, I think, we could easily classify as breaking of the ice, going through support. And look how far down we come relative to the previous rally. At this point, on that last second reaction down, even though it recovers quickly, look how far down we come relative to the major uptrend that led us into this trading range to begin with. So a pretty good sense that there's definitely a change of character here, and that we may have already gone, and Roman's got really excellent perception on this, so I'm sure he's going to have comments too, but that we've already changed the bias from bullish to bearish. But now look what happens out of this major sign of weakness. Look at this rally, and it looks pretty bullish. I mean, it moves aggressively. There's good continuation. But as Roman is saying, this is one of our phrases from WTC, looks bullish, acts bearish. And we have another term for this rally, which is the second point of excitement, where buyers are thinking, okay, it's time for Tesla to ride again. And, we want to be on board. But look at where this is able to come, a lower high versus any of the previous sort of significant highs in this trading range. One last attempt on a nearby local basis to upthrust, which is immediately reversed. And look at this point of entry. What a thing of beauty. What a thing of beauty. So we get this, and remember, this is puts. So we're coming in right at the basically the reversal of this last second point of excitement, last point of supply, and we're reversing to the downside in a major way. And we've got POE number one, we come down, we make a really feeble test, attempt to go back up, look at that black bar, which is trying to go up, comes back down, closes at the low, even though it's up slightly. It's an upthrust. It's, again, a local upthrust, even more significant than the previous one where Roman got in initially. And then look what happens right away. Talk about synchronicity. Look at this next 1, 2, 3rd bar. Look at how aggressively supply comes in. Look at how aggressively price moves to the downside. So Roman has absolutely nailed this move. So that's the setup. That's where we are in the trade. So Roman, what do you think? What do you say?
Yeah, I think your description of the analysis was so perfect. So thank you for this. It's important for us to recognize where the bias has switched because right here, what's the most important bar to the upside? Which is the bar that has like this, a lot of demand, a lot of buying. So this one right here. So here's our buying zone. So the first bar does not, the change of behavior bar does not really changes the bias. You still should be bullish at this point. The failure of the secondary test to touch the high of the buying climax also doesn't do that. Minor sign of weakness starts suggesting that maybe something is going wrong, but you need one more leg to confirm that. So this rally with so much demand behind it and the failure of that into the lower high suggests that we could be in the bearish bias. And then the key becomes is like this whole retracement into the low of this demand bar, and after the failure into the lower high, retracement more, and significant retracement below this bar. So here you already know we are in the bearish bias. And then you just seeing diminishing supply, exhaustion by sellers into the test of the local spring, and your expectation is for the rally. And pretty easy from here because with the rally, you're just basically doing what? You want to identify the character of the rally and you want to identify the result. The result is the most important one. By the result, we're seeing that we are coming to this point and we are reversing, and therefore we are failing. That reversal and last up bar happens on diminishing demand, so exhaustion by the demand, then you take the position on the reversal where supply starts to increase at the same time. So everything is there, for us to take. Also, I have used 2008 Apple analog for this trade, which worked out really well. So just check this out. Okay, so what about the trade itself? I think the points of entry are actually okay. I could argue and make an argument that this last kind of like climactic push to the upside was the diminishing demand signature. Look how demand is increasing during the rally and then decreases. This is very important because it identifies the timing where the put position would be opened better, right? So not at this close, but at this close. So you kind of would have maybe additional $50 here of efficiency, in terms of the entry. And again, Franz has said, like, I'm going to be hard on myself. I will be, because that's how you improve. Your improvements are going to be marginal at this level. So I was actually discussing it with our student prior to this session. And he said, I'm doing a lot of simulations, which is great, which I would advise you guys to do a lot. And he's like, the 80% of improvements for me came from the initial 20% of the time spent on the simulation. So your improvements are gonna be very visible at the beginning of the simulation process. And then I said to him that the marginal improvements after that is going to require 80% of the time to cover 20% of the results. And that's kind of like what it is. You have to push yourself into like discussing this type of points. Why not opening position here instead of here? What's the rationale there? Do I see this technically? Yes, I saw that. Maybe I was not available to act on that. But okay, let's move on. Second point of entry. I like how I'm waiting and I'm opening after the attempt to go up. So the rally is developing and on the on-demand bar. So that made a lot of sense. What didn't make a lot of sense is this black bar is earnings. So you kind of expect some kind of volatility right there. My expectation was that earnings would produce a negative reaction, and therefore from here we're going to go down. So I was itching to get into the position into the second point of entry, pre-earnings. Earnings initially in the morning were positive reaction, and then into the end of the session, obviously more negative, which suggested another point of entry. So should have added a third unit right here. Okay, so then everything is going well here. We just trade in. Our target zone is the previous support of the previous rise. This was also kind of like a potential stop in action here. And we are not interested in trimming the position or closing the position before those points. Also, the break itself that comes here, and this was done on the selling of the shares by Elon Musk for his Twitter deal. So I think he sold like 8 billion, if I'm correct, or something like this, or maybe for other purposes. I just remember that piece of news on that bar. And look at the extension to the downside of this bar. What do we see here? Strength to the downside, suggesting continuation. So there is no reason for us to trim here. We could have trimmed here, and I'll come back to this. We could have also additionally opened the position here with an expectation that there is enough room here for us, to the first target and to the second target zone as well. But we don't, so we just go down, and nothing happens here. The analog was suggesting that we're going to have the rally here. The analog actually suggested opening another position right here. I did not do that, so that's kind of like a part of that, like, collection of mistakes here. And then to the downside, the exit seems to be like, like it's great. So the exit was actually on this day right here at this close, and then at this close. So all in the vicinity of the low. I mean, like, naturally, I wouldn't have any complaints about this, but these are options. So therefore, there are some complaints about this. Complaint number one, or mistake number one, I need to exit my options positions on increased volatility. That's number one. Also, exit at temporary stopping actions. Thirdly, re-enter or add more on up bars in the reaction. So for instance, somewhere here, somewhere here, somewhere here. So those were potential add-ons. And this place right here, this place right here were potential trims. Now, why would I say this? I mean, like, you would be thinking like, yeah, this is a good enough trade. Yes, it is. But again, like, how do you improve that? Could you improve even that? Could you be more efficient? And I'm gonna tell you, like, why I'm thinking this way. For instance, by the end of the trade, the profitability, the P&L was ×5 on the original size of the position, which is pretty good. And the reason why it's so high, one might ask me, like, oh my gosh, you invest like 10 grand, you're gonna get 50. Yes, that's what you get. But it could have been ×7 and ×10. A pretty significant swing in the P&L. And that's what bothers me right here. That's what I'm after. I'm after efficiency. Efficiency in trading. So you could have entered better. You could have added more. You could have trimmed, then added again. And this could have been even not ×10, but maybe even ×15, ×20 type of opportunity. So when I'm looking at my final results, which was ×5, and I'm thinking about of what could have been if I would be much more efficient, then it makes a lot of sense for me to go and to kind of like be a little bit hard on myself and start learning a little bit more of how to be more efficient with this type of trading. Because, as I always say, there are plenty of opportunities out there in the market. I mean, literally each day presents us with millions of opportunities on different assets, different timeframes, in different environments. So quite a lot of opportunities. there are fewer opportunities that out there that we're going to see, that we're going to recognize. So that universe collapses pretty fast. There are plenty of opportunities that are out there that we could see, but we cannot execute on. Then there are plenty of opportunities that are out there that we could see, that we could execute on, but we are not executing on them efficiently. So that's kind of like my mental outlook on this. And I know that it's a little bit too much to ask, but I think that, you know, some of you out there will support me in this thought and will understand what I'm trying to achieve here and what I'm trying to do here. So with that, Franz, I think, like, you know, these are kind of like the 3 mistakes that I've identified, and they should go here. We could do the variance really quickly, and I'm very curious about like your assessment of what I'm trying to achieve here.
Okay.
So maybe
okay.
bias, yes.
Well,
right?
before we move, I just want to reiterate one thing that you said, which is the timing signal.
Yeah.
It is so intriguing. In this looks bullish, acts bearish rally, the volume signature and this last bar where we see less effort actually, and at least near term, some attempt to improve the results. That, because of the less effort, that's a really difficult read, and I think contextually we have to understand what's going on rather than just say, okay, well, we've got a reduction in volume on this bar, so we should be expecting that as a timing signal, right?
Well, a couple of things here. This looks a little bit climactic. We got 2 days of the reaction, which we haven't had before. We had only 1 day of the reaction. We have 2 bars, demand bars that are going down, and then suddenly supply is increasing on this bar. And it looks somewhat climactic on this upthrust. So you could find the reason to kind of see it this way. So for instance, this one is kind of the same, right? So volume signature goes down, suddenly supply is there, and we have this last climactic run right there. This one is here the same, where slightly different, right? So this is like complete deterioration of the demand and complete deterioration of the result to the upside. So those are going to be, you know, visible to us. We will see them. We could identify that. Should we go through the variance?
Well, hold on 1 second. There's one last thing I want to point out, and that is where your trade could have been X10. It is actually at a higher low.
Yes.
And I think this is something of a unique nature of options.
Yes.
Obviously, if this was a cash trade, you're going to make the most money at the ultimate low.
Yes.
But in options, because of the whole, you know, the whole volatility thing and all that, it's a different animal. So
such a great point, Franz. Time duration is very important for options, so expirations. Also, the volatility itself, right? So here we are gapping down, and in the morning we have like times 10 on the position. Behind that gap, behind the volatility, behind that volume signature. As we go into the next drop, we're still relatively profitable here, but now time elapsed, and it's additional week. And those are short-term options. So the time collapse, the time premium collapses pretty fast. And then once we don't have on the exit bars, we don't have any volatility, we don't have any volume increase, we don't have any like significant, you know, like gap activity, although on one of them we do. So that collapses the profitability to times 5. So quite frustrating right there just to go through that. And still, you know, like on the background is like, you gotta close, you're gonna have a rally, and that rally is gonna be the best rally, change of behavior rally. So you don't wanna lose even more. You don't wanna go to like times 3 or times 2 on the position that was so profitable.
Okay, good lesson. Good lesson. And
Yeah.
for everybody that's listening, I keep asking questions because we're not going to let this guy off the hook. When he comes to join us, he's going to divulge all the information we can possibly wring out of him. So, so that's the last question though that I can think of right now, looking at it. So back to your post analysis: bias clearly yes, timing clearly yes. Character definitely, points of entry definitely, stop loss. I assume you had a stop loss. Add-ons, you did have one add-on. You could have had another one maybe, but it looked good anyway. And the exit yes as well.
I would say maybe like 50-50 here, just because, I mean, if I'm trading options, I should have exited on these two bars. Those would be a much more profitable. So just from that perspective.
Okay.
Maybe even add-ons like could be 50-50 just to add a little bit more add-ons. Yeah, so something like this. So we have like what, 6 out of 7.
6 out of 7. For your standards, it's an 85, which is very good. And you're never going to be satisfied, I know, but it's a great trade. So let's go into the comments and lessons. And you've already highlighted them. And personally, I think some of those are actually rules. So
Yeah.
they belong in both columns.
Yeah, for sure. I mean, like, again, it's just that the options trading is so different, let's say, than cash positions. So you have to think about the time collapse, about where you should be entering and should be exiting, because your profitability changes drastically. As you could see, like, seems to be like a good trade could have been an excellent trade and could have been like a very outlier unique trade. If I would be more proactive with the trims and the add-ons. And I want to kind of like point this out where, what would be the ideal trade, right? Ideal trade, point of entry right here. I think that this one is still warranted, but add-in position right here. Let me just take another color here. So like first point of entry, second point of entry where it was done, third point of entry right here.
I'd call that a know-it-all bar, right? Would you?
Yeah, for sure. I mean, like, it felt really good on that bar. Like in the morning, when there is a gap, you're like, okay, I'm just not gonna look at the P&L. I'm just like gonna kind of like see what the close is gonna say, and the close is like screaming at you. Yeah, supply is there. And then I think what's next is that on this bar right here, you have enough volatility. It slightly decreases in the volume signature here, and the spread is decreasing relative to the break. So this is in the vicinity of the previous buying. So you want to trim your position here.
Premium is probably taking a big jump right there.
Yep. Yeah. So I don't recall exactly, but at that point you already like at maybe like ×4, ×3, something like this. So pretty substantial profit. Take it, and then based on the demand signature, here's where supply is coming in again. It's ever slight, and in the body of this bar, slightly above 1/2. So open the fourth position right here, and your premium here is going to collapse to maybe like 1.5, something like this. So you're buying it at the cheaper price at this bar, and then instantly supply is coming in, confirming that, and so on and so forth. And until this bar, you kind of like should be holding on. This shows that there is a temporary stop in action in the vicinity of the previous spring, in the vicinity of the previous kind of like stopping before. Trim here again. So here you would be already much more. If you're doing like all of the streams and add-ons, you probably more than ×10 for sure. And then by the analog, do number 5 add-on here with anticipation that you are going to have some kind of continuation, but maybe the majority of the strength behind this was done. I was actually looking at I was trading actually the volume signature for the exit. My to the left here, there is a volume signature that's even higher than this. So I was kind of hoping to get that type of volume signature. It's at least this one right here. So this was not that substantially, high enough for me, to warrant any type of exits. It's only after the fact you kind of like see this. Then definitely exit here, exit all of it, or the majority of it, and then the last exit should have been right here, where you don't have a lot of volume signature, but this is like, that's it, I'm done. There is selling deterioration, there is not expansion of the result to the downside, especially relative to the low here, and like this is diminishing thrust, shortening of the thrust. Here we are expanding a little bit, at least. Here we are not. So this is a must exit, and just don't even wait for the reversal. So those are kind of like small mistakes, but it's kind of funny how small mistakes, and you could say like, oh, it's options. Yes, it's options, but those small mistakes also could be in the cash position as well. I mean, like you could have like trimmed, added more. And sometimes, like when you are in the correct trade and you know it, you gotta be a pig. You gotta be bold and brave. Whatever you want to use, like push yourself to the uncomfortable size where like you are on the edge of, like, you don't want to go into the drawdown, but you see the logical sense to increase the position to almost like specialize in only this position for this period of time, and then make that significant contribution to your portfolio equity.
Yes, yes. And to that, I would simply add that we went through a lot of analysis here to get to this trade. And it's not, just playing roulette with one bullet in the gun, Russian roulette. I mean, we're doing a lot of analysis to come up with the idea that this is a valid trade and not just throwing darts. The old saying, and Roman likes to say, be a pig, but there's also a saying that on Wall Street, there's room for bulls and there's room for bears, but hogs get eaten. So until we know what we're doing, and Roman obviously operates at an elite level in his trading and is able to see these nuances. So that's why we're doing these post-trade analysis, so that we can all pick up on what he sees and incorporate it into our own trading. So Roman, thanks for the great lesson, and congratulations on a really, really nice trade.
Franz, thank you so much, and to all of our listeners, watchers, thank you for watching. Thank you for supporting this particular series. It's very, very important that as you watch, don't be just the watcher. Be proactive. Analyze your own trades. I mean, like, the reason why we do this series is just for you to understand the process of post-trade analysis and encourage you to do the same for your trades, whether those are winning trades or losing trades. And we have to study both. So with that, Franz, thank you so much. And I'm looking forward to the next cameo, at some point in the future.
You might be up for an Academy Award. You never know.
Okay. All right, guys.
Till next time.
Bye-bye.
Thanks.